There's two types of options, puts and calls. And today we are going to be talking about puts. So options are contracts, and each contract has a buyer, so a person who's buying the contract, and a seller, a person who is selling the contract. Same thing for calls, which we're not talking about today, but there's a buyer and a seller. Okay. So, puts. Now, the reason why this bear is bandaged up is because I want you to think of puts like insurance, right? Like car insurance or health insurance. And so I'm going to explain. So, buying puts. This is buying a put, okay? So, every month you drive your car. That's you, that's your car. And you have car insurance, okay? So let's say you pay your insurer, let's say you pay them $100 a month for car insurance. So that means that for a period of time, let's say from January 1st to January 31st, if something bad happens to your car, if you get in an accident, because you paid your insurance company $100, they will cover the cost of the damages, okay? They will absorb the damages in exchange for this $100 fee that you paid them. Now, a few things about this $100 fee. This $100 fee is non-refundable. Once you've paid the $100 to your insurance company, you don't get it back, regardless of whether or not you get in an accident. So I want you to keep that in mind, okay? I want you to keep in mind that when you buy car insurance, it's only good for a set period of time, right? That policy expires. You don't get to buy insurance once and you're covered forever. Okay, that's number one. Insurance expires. Number two, I want you to consider that the premium, the price you pay for your insurance, is non-refundable. Premium is non-refundable. And three, I want you to consider that your policy is only useful if something bad happens to your car, okay? If nothing bad happens to your car, then this policy will expire worthless. And all you'll have in exchange for it is the peace of mind, okay? So, expires worthless if car is not damaged. Cool. So, all of these things apply to options. So now that you've got that thinking about car insurance in your head, I'm going to explain to you how buying a put option works. Now, buying a put. So, in the last example, we talked about insuring your car. But now, instead of thinking about insuring your car, I want you to imagine that you are insuring 100 shares of stock. Okay? That is a put contract. It's for 100 shares, so 100 shares of stock. Now, let's say for $100, okay? So the same $100 we have in this example, so it's $100. For a set period, so let's say from January 1st is the date that you bought this put to it expires January 31st. If something bad happens to the stock between January 1st and January 31st, just like with car insurance, you have paid for an insurance policy. You have bought a put, which means someone else has to pay for your stock, just like someone else would have to pay for your car if you have car insurance. So let me explain. I'm going to explain exactly how it works. Okay. So, let's say that right now, this stock, all right, our 100 shares of stock, which we're going to call XYZ stock. Let's say that right now it's trading at $5 a share. Okay, so XYZ stock is trading at $5 a share. Now, we spend $100 and buy this put, okay, this insurance policy, so that someone else will buy XYZ stock from us for $4 a share. Now, if XYZ stock is currently trading at $5 a share, why would we pay someone $100 to buy it from us for $4 a share? Why would we do that? Well, because let's say, right, the policy protects us from January 1st to January 31st. So let's say on January 15th, XYZ stock plummets, okay? And it goes to just $1, okay? We were at $5, we go all the way to $1. Well, now we get to sell XYZ stock, not for $1, but for $4, okay? Even though it's only worth $1 on the exchange, we get to sell it for $4. And that is because we bought a put. We bought an insurance policy. Now, this is important. So just like with insurance policies for the car, all of these things are true for our put. Okay? So 1, all options, calls, puts, they expire, okay? They expire. They're only good for a certain amount of time. They're not like stocks that just trade indefinitely. They expire on a set date, okay? 2, on a set date that is in the policy. It's part of the agreement. It's part of the put. They expire on a set date. 2, $100 premium is non-refundable. Once you pay this $100, okay, for your put, you don't get it back. Okay, so premium is non-refundable. Now, we made that money back, okay, because we were able to sell something that was only worth $1. We were able to sell it for $4, and thus we effectively, right, we basically made that money back. But we don't get this same $100 back. That is kept by the seller. And 3, the put expires worthless if stock does not go down. I can't write all that, so if. I'm just going to put if ... stock does not go down. So let's say in our example that XYZ stock, instead of going to $1, let's say that it goes to $15. Okay. Well, our put allows us to sell the stock for $4, but that's not very useful if it's trading for $15. So basically, that $100 that we paid, it's useless. The policy expires worthless. We just lose that $100. But we had peace of mind. So it wasn't completely wasted money because we had peace of mind. Really quick, I want to make one thing clear, okay? You can use the put option anytime you want from January 1st to January 31st, okay? So this put option will allow you to sell XYZ stock, XYZ, for $4 at any time between these dates. Okay? So, for example, XYZ stock price could drop to 10 cents. That does not mean you have to sell it for $4. You can choose not to. Okay? And it can go up to $15. You can still choose to sell it for $4. Okay? What the put does is it gives you the option to sell the stock for $4 anytime between these dates. One more thing I want to say, this might sound confusing, so if this confuses you, forget about it, move on. You don't need this information right now. But I want to say that you do not need to own XYZ stock in order to trade the put contract, okay? You can trade the put contract without having to own the underlying asset. It's about buying puts. Now we're going to talk about selling puts. So if you are the seller, you are just on the other end of that transaction, okay, that we just talked about. So that would make you, in that analogy, you are the insurance company, okay? You are selling the insurance. So what does that mean? That means when you sell a put that you get the premium. So that $100, actually decided it's probably better to do it here with the car, okay. So the $100, you get to keep it, okay? 100, you get to keep. So whenever you sell a put, you get instant money, okay? You get to keep the premium. Now, selling puts is pretty cool because one of two things is going to happen when you sell a put, okay? The first thing that happens is that the put option expires worthless, right? The car wasn't damaged, the stock didn't go down, and you get to keep the premium, okay? Keep premium. And that's it. You just get to keep it. You made $100. Awesome. Good for you. Okay? You get to keep the premium. Now, second thing that could happen. Second thing that could happen is the stock gets put to you. Okay? Stock is put to you. And I put that in quotation marks because that's what we say. We say, oh, the stock was put to you. So what does that happen? That means you still get to keep the premium. So you still get to keep the $100. But in addition to that, you had to buy the stock. So let me explain what I mean. Explaining what I mean. Again, we're on the other side of the exact same transaction as before. Okay? The exact same example I gave before. So let's say XYZ stock is trading for $5 a share. Okay? You sell a put. So you earn, get rid of all this. You earn $100, and in exchange, you agree that you are willing to buy XYZ stock for $4 a share. Okay? It's currently trading at $5, but let's say it goes to $1 per share. Okay? XYZ stock goes from 5 to 1. Okay? You still have to pay $4 a share for it. You have to pay $4 a share. You get to keep your premium, but you have to pay $4 a share. So for 100 shares, that means that you lose $300 on that transaction. But you get to keep this $100. So actually, you only lose $200. Okay? Now, this is actually pretty cool because if you wanted... This is pretty cool because if you wanted to buy XYZ stock at $5 a share, but you thought it was too expensive, $4 a share is a discount, right? Especially once you add in the amount you get for a premium. So if you were going to buy a stock anyway, but you think it's too expensive, one strategy is to sell a put instead of just outright buying it. Okay? Recap, when you are buying a put, you are buying peace of mind, okay? Peace of mind, okay? You are buying an insurance policy. That's what you're buying. And when you're selling a put, you are getting a premium, okay? No matter what happens, a premium that you get to keep. And potentially, you get to buy the stock on sale. If it gets put to you, you will buy the stock at a lower price. That concludes my presentation on put options today. I am a little bit oversimplifying on some things. However, if you can understand everything that I'm saying in this video, you've got a very good basic working understanding of how buying and selling puts works, how put options work. And as you continue to watch other videos to talk about the more complicated aspects, you will build on that and you will get a broader and more complete understanding of this. Let me know if you have any questions or want me to make any new other videos for you. Thank you.